2022 has been a difficult year. We've got stocks downs, we've got bonds down, high yield, crypto. It has been a difficult market. Now, inflation stays sticky. Fed is raising rates. What is the impact? What do we see going forward? Lots to talk about today. Let's go. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First time here, we are a registered investment advisory firm, meaning we act as a fiduciary. Also, what you hear and see here, we do apply to our portfolios, our clients, etc. So if you like what you hear, looking for a different opinion, that of Old Wall, please do consider subscribing. So, as I mentioned in the intro, it's been a difficult year. Not a lot of places to go, okay? When you look at what's happening here, are we at the end of it or the beginning? Well, the Fed still has a way to go, still going to continue to raise rates, which we have not even seen the impact of that yet. We'll discuss that more in detail. So, today, as always, we're going to go through the charts. We're going to talk about where we are, where we're going, also the cycles, the macro backdrop, and then at the end, we're going to talk about game plan going forward. Let's go to the big board. First up, we're going to look at the macro view. As part of our process, we do have several pieces of that. We work with 3 different research firms to bring us all this data to help us make these decisions. But the most important part, the backbone, is the cycles, okay? You've watched me, you know, we are in cycle 4. Growth slowing. Talk about that in a second, right? Inflation decelerates. Wait, what? We saw what happened this week. Yes, there are some numbers, talk about that, but it did decelerate, so we are slowly starting to see disinflation. Now, normally the Fed is dovish, but of course, they are very hawkish right now and raising rates, which has never happened. So let's get into this a little bit and why we feel we're here. So let's look at the growth picture. So just on Thursday night, FedEx came out and talked about a global recession. Okay, do agree with that assessment. Our cycles are not just for the U.S., they are global. We do believe that is the case. Talk about that in a second, okay? So with that, you've got GDP. All right, started out the quarter looking at a 2.5%, I believe 2.6%. As of Thursday, it's down to 0.5% growth. Understanding we've already had 2 negative quarters in a row, which historically has meant a recession. So it'll take a while, but as they say, the trend is not your friend. Now, we've got 30 different growth pieces we look at. I'm just showing you a couple high-level ones. So look at some of these pieces here. Credit card balances through the roof because personal savings is down. Hourly earnings are down. Mortgage apps have just crashed right off there, right? Housing affordability is still at an all-time high. Retail sales are down. Household net worth down big time last quarter. Layoffs are starting to happen. We're seeing that across the board. This week, big announcement from Goldman Sachs, laying off hundreds of their folks. Talked about GDP. Europe, not going to get too much into that, right? But global, 2 key components when I look at global. China, on the emerging market side, having big time issues in cycle 4. Europe, big time. Their inflation's out of control. I'm sure everyone's heard about all these rates and electricity rates, and it's going to be a tough winter in Europe. And don't forget, okay, they buy American goods, right? With the U.S. dollar up, it does hurt things. Talk about that in a second. Manufacturing and consumer confidence. So not a good picture here on the macro side, okay? Then you look at inflation, as I said, right? Market sold off, okay? We did go down a little to 8.26%, all right? But the problem is there's some sticky items. Everyone thought it was going to go down big time because of oil. Oil has pretty much crashed, right? Down 25%. but there's other components. One of those, a real important component, is shelter. Okay, that's housing and rentals. Now, that's what you're seeing right here. Look at the year-over-year change. The problem is this is a big-time lagging indicator. The number was about 6.2% for shelter. Our research firm has it over 10%. There's more pain to come. Also in that, medical was up. And of course, right, groceries were up. And that's why we're seeing this sticky inflation. Okay, next up is the Fed part. All right, here's what we have here. This comes from our research firm saying 7.65 more rate hikes. Now you take that times 0.25%, that's how they raise it. So we're looking about 1.5%, okay? Expectation this Wednesday is 0.75, okay? So what's the issue or problem here? Talk about a soft landing in the opening, right? No chance, by the way, okay? You got a couple things. One, the Fed has never raised rates into a slow growth economy. Just showed you, right? Everything is slowing down across the board right now. So they're raising rates because of inflation. They have to. They're behind the curve. So this is a big issue. The other thing I want to make sure, crystal clear, okay? When they raise rates outside of mortgage interest rates, we don't feel it for 4 to 6 months. So the pain comes down the road. That's why you heard some big names this week saying we should stop, only do 25 basis points, let's digest, because this is the most aggressive the Fed has ever raised at one time. So, big issue. Now, we start with the macro view, and then we're going to take a look at the charts. Let's move over to that right now. All right, so again, different parts of our process. We look at the macro, confirm, follow, look at the technicals, which are the charts, because the markets are being driven by momentum, right? And you see that in the charts. First up, we've got the long-term view, which is the monthly view. All right, down here is momentum, clearly negative, have had a negative crossover. Okay, what else do we see? This line right here is your 12-month moving average, right? We went above it, but then we failed, okay, failed again. And then now, if we were to close on Friday, we're seeing what's called a reverse candle. Not a good look, but right now, the trend is to the downside on the long-term view. Of course, this would be negative. Now, on the weekly chart, okay, I actually went all the way back to 09, and I'm showing these channels, okay, very definitive channels that you're looking for, right? At one point, we broke above. Obviously, that was very bullish over here where I circle, okay? And the key support is this line here. Now, we bounced off it in June, heading towards it now. We need to hold that support line on the market to make sure we don't go lower, to be determined. Right now, of course, this is definitively negative. So short term, I look at short term, 0 to 3 weeks, midterm, 3 weeks to 3 months, and then beyond that, it's long term, okay? So here it's showing you all the bounces we've had this year. Of course, our most recent, we saw this surge of 14%. Talked about this already with our clients. Biggest short squeeze in history, okay? Now, yes, we made it back. We failed at the 200-day moving average, which was real important, okay? From there, we're now down 10.5%, call it, from the high of August 15th. Friday was not a good day. Kind of reversed a little bit. Still have a way to go for the month, and we'll see what happened. Now, if I look at this and can see anything that is not negative, because we are negative over the short term, definitively in a downtrend, is the VIX, volatility, okay? Normally, when you're really seeing a big sell-off, you see a couple things. Volume, yes, we're seeing volume more up on sell days, which you would expect, than on up days, but the VIX will surge big time, okay? We haven't had that. We're really not seeing that surge above 30 and sustain it, okay? When you look at it, I've got it down here at the bottom. A little bit there, of course, back in June, and then we've come back. That's when you look for, if we see a sustainable surge above 30 going forward, then more selling, more volume, maybe at that time we'll find a bottom, but we're not there yet. Obviously, this is negative. Next thing, this is the NYSE is the blue line, so the full market. The histogram is new highs minus new lows. Friday over here, you can see we had negative minus 349 companies making new lows versus new highs, which is the lowest we've seen since our June lows. So we're going to watch that this week and see if we can turn that around. Now, we've had a lot of selling, might see a bounce. Seems that at this point, we continue to go from overbought to oversold conditions. We'll see what happens this week, but of course, the trend is still the downside. Here's the NASDAQ. What do we see here? Here's your high back in late fall, December to Friday's close. You're down 30%, okay? NASDAQ tech is really getting hit. Expected, okay? Saw some names, big names this week getting hit big time as we go forward. So next up, Sector Spotlight. All right, we're going to start out with the U.S. dollar, all right? On the U.S. dollar, you've heard me say in the past, if you get that right, you get a lot of things right, okay? Because it really does work only in one cycle, which is cycle 4. You can see that surge. This has been our top holding. We trimmed it at one point. We added back on Friday, okay, with everything going on. But the dollar has been one of the few performers this year in the overall market over double digits. So at the beginning of the year, I talked about the 10-year being the most important chart of the year. Now it's become the most frustrating chart of the year, okay? So one of the issues, the only issue, is inflation, right? So when inflation is high, you're going to see the 10-year go up. Now, despite an 8.26 inflation number, it still is hung in there, okay? So when you look at this, up here, that's 3.5, and we've got about 2.77. So you've got major resistance. As of now, it's held, okay? And then you also have that support. Every time we went down here, we seem to have bounced back up, okay? So very small, rather be in cash than bonds right now. We've got 10 or just under 10% in a couple short duration bond funds. We'll talk about that. But once this happens, eventually, we feel, a lot of people feel, heard some big names this week say the same thing, that the long treasury is going to be the place to be. Once people realize it's not just about inflation anymore, it's about slow growth, that's when we'll see the 10-year go. And I will tell you, every time in history, when we've entered a recession, okay, so that's a long time, a lot of times, the 10-year's gone down. So that's what we're waiting on. It is stubborn. And we have to be a little bit more patient, but the opportunity's there, okay? You look at some of the ETFs, you can go short term, 7 to 10, 20-year, whatever the case might be, all right? This is TLT, about a 20-year ETF, one of the most utilized ones out there. You can see 18 million shares traded just on Friday, and you see from its high back last fall to its low, it's down 30%. Bond fund, down 30%, right? This is a supposedly risk-off asset class. So I'm not saying there's a 30% opportunity short-term, but there is definitively a lot of upside. From there, one of another asset classes that we really like is gold. In this environment, again, very, very small position, waiting. 10-year and gold is very much correlated. They work together, okay? They move together, excuse me. So same thing, we've seen the breakdown. Here you've got about 20% upside, and that's just to March, okay? So once that breaks, we do feel we're going to see some nice opportunities there. We could take a look at healthcare, have a couple individual names that have done really well, have held up. Healthcare kind of trading in a range. All right, next we've got utilities. Utilities will perform well when 10-year goes down, although year to date, you can see it is one of the few sectors that is positive year to date. We own the ETF here, which is XLU, couple individual names, nice dividend payers. We'll see what happens. Now, let's get to the all-important game plan as we go forward. All right, pretty short list. Follow us for updates, Facebook, Twitter, whatever one. Try and put out charts and articles to help folks. The Fed is way behind the curve, okay? When I talk about that, Jackson Hole, Chairman Powell came out with some tough talk, right? We're getting after this no matter what. And they have to, because inflation continues to be pretty rough, okay? So let's see what happens on Wednesday. That's going to give us a good guide. Going to be very patient until Wednesday before we do anything. You know, the yield curve, 10-year -2, didn't show that today. Back to minus 0.41%. Once you invert, that shows a recession. Not a good sign. Look for those transition. If we get that break in the 10-year, we'll start incrementally adding to both bonds and gold. Cash, we've got the largest position we've ever had right now, has helped us on some of these aggressive sell-offs like we saw in the last 2 weeks or so, okay? But eventually we want to deploy that to areas that are going to work in this deep cycle 4 and an opportunity. Sell on strength. If you have some items, sell on strength, right? Some of those tech names you might still be holding on to. Okay, if we go, we could go further. So be smart, sell on strength. As always, we appreciate your time. Thank you for watching. Michael Loftus, Wealth and Wisdom TV.